Following a large uptrend, a moderate correction marks a clear high in the upper 60s. Close attention is paid to the upper 60s range, where a less strict double top has been quickly reversed. An unusual event with the current large green candle having even higher volume than the candle before it, but it closes significantly lower. This points to volatility as it takes place near the site of the last two clear downswings. Not to mention daily candles are covering wide fluctuations in price. Plenty of contention in the mid-60s in the short term sees the bearish advantage prevail. July to August saw a volatile double top that was slightly spread out, but still close to the strict M shape. It combines with the early May downswing to form a less strict triple top drop that has been swiftly reversed in the last week. The overall range could also be called a flat top, if the minor downswing is counted in the wider resistance range during the middle bearish spike at the end of May. Regardless of whether it was a flat top or triple top, the upper 60s were revealed to be a clear resistance range that has managed to oppose the bullish surge in mid-September. Highlighting and outlining helps define the context of what is developing into a successful consolidation over prior highs in the 67 range that now provides support in the climb to new highs. Overall, this has been a horizontal range marking the resting phase in the larger uptrend. Technically, an ascending triangle can be drawn with minimum criteria. However, it is a less strict ascending triangle due to being in a range-bound context, rather than a straight uptrend. The uptrend remains strong as the ascending triangle's uptrend line is not even contacted. Selling volume is moderately bearish during the formation of a minor downtrend. Selling volume diminishes to avoid a continuation drop. This leads to a failed descending triangle. The uptrend line is still highly influential after being crossed several times, which is less common. It even runs through the candle just before a moderate gap up in early 2015. In addition, it provides temporary support before the bearish acceleration that now takes place after the recent gap down. The 94 gap up fill shows once again why a price level at or near the closing price of a candle theoretically marks the focal point of a gap fill zone. This is evidenced by the late August reversal candle opening to form its real body close to 94. The wider gap up fill range conveniently encompasses the large reversal candle in late August. The uptrend line still has residual influence as the gap down is filled. Early bearish sentiment from the dark cloud cover at 120.50 is built upon soon. Amazingly, the uptrend line demonstrates the secondary characteristic of temporary support, stalling the accelerating drop in December. Then there is roll reversal as seen by the sharp downswing, directly off the still influential uptrend line. Interestingly, a downtrend line can be plotted from the recent drop using the prior downswing in mid-December. The incidental X that is formed provides a nice visual representation of overwhelming bearish context in recent times, overcoming the residual influence from the past uptrend. The crossing back above 94 and the steep downtrend line are results of a disproportionate bearish move. In the transition to 2016, the near vertical drop did not match the declining bearish volume. That is a large part of why there was such a rapid bullish reversal to begin February and the relatively passive rise that followed. The wide 94 to 122.50 range marks another large container to mark the resting phase in a long-term bullish continuation. In late 2018, there is an interesting example of how medium-term resistance produces some sharp peaks that culminate in a double top. This takes place in price action that is similar to the outline of a head and shoulders. This would be a loose interpretation of a head and shoulders with two sharp downswings where the head would form. However, the same general price action is useful in determining the key boundary around 110 that is like the neckline. During the historic year of 2020, the 116.50 to 122.50 range was reused to mark a widened gap fill zone that did temporarily support the major drop into March, prior to the bearish continuation that returned price back to the area of the key 94 and 78 levels. The 116.50 to 122.50 range is certainly a primary area of interest for many market participants. That is why it continued to have so much activity, some of which included gradual roll reversal from resistance to support, along with 3 gap ups directly in or very near this range.